In the bustling streets of 17th-century Amsterdam, the world's first stock exchange was born. Amidst the golden age of Dutch prosperity, savvy merchants and explorers wanted a way to share the risks and rewards of their perilous voyages. Thus, they created the Amsterdam Stock Exchange, a platform where they could trade shares of their ventures. This ingenious invention sparked the birth of modern capitalism. For the first time in history, anyone with a bit of money could invest in a company, becoming a part owner. This wasn't just about wealthy elites anymore. The common man could now dream of prosperity. It was a revolutionary concept that forever changed our economic landscape. This marketplace of ideas, of dreams, and of risk allowed for unprecedented growth and prosperity. Yet it also set the stage for financial calamities that would echo through the centuries. This marked the dawn of a new era, the era of financial markets. Fast forward to the 20th century, the Roaring Twenties came to a sudden halt with the crash of 1929. As we journey further into the annals of financial history, we find ourselves in the midst of the Great Depression. The crash of 1929, often dubbed as Black Tuesday, marked the beginning of a decade-long economic downturn that swept across the globe. It was a time of immense hardship, with millions of people losing their jobs, their homes, and their hopes. But what led to this devastating event? The causes of the Great Depression were manifold, but two key factors stand out: speculation and lack of regulation. Let's take a closer look. In the years leading up to the crash, the stock market had become a playground for speculation. Investors, both big and small, were buying stocks on margin, essentially borrowing money to purchase more shares. This created a bubble that, when burst, led to panic selling, plummeting prices, and ultimately, the market crash. Coupled with this rampant speculation was a lack of effective regulation. The financial markets were largely unregulated, allowing for risky behaviors and practices that contributed to the unstable market conditions. This absence of oversight and control further exacerbated the impact of the crash. The effects of the Great Depression were devastating. Unemployment soared, reaching as high as 25% in the United States. Businesses shuttered, banks failed, and millions found themselves in dire straits. The economic landscape was bleak and the future uncertain. However, out of this crisis came significant economic reforms. The United States government introduced a series of measures, known collectively as the New Deal, aimed at stabilizing the economy and preventing future crashes. These reforms included tighter regulation of the financial markets, the creation of Social Security, and large-scale public works projects to stimulate economic growth. In the face of adversity, these reforms represented a beacon of hope and a testament to human resilience. They demonstrated our capacity to learn from our mistakes, to adapt, and to forge a path towards a more stable and prosperous future. The Great Depression was a harsh lesson in the dangers of unchecked speculation and lack of regulation. As we approached the new millennium, a new kind of euphoria swept the markets: the dot-com bubble. This was a time when the internet was relatively new, and its potential seemed limitless. Investors were eager to put their money into anything with a .com in its name, and internet companies were sprouting like mushrooms after a spring rain. This was the rise of the internet companies, a period marked by an explosive growth in the number and value of these tech startups. The term irrational exuberance perfectly encapsulates this period. It was coined by Alan Greenspan, then chair of the Federal Reserve, to describe the over-optimism that led investors to overlook traditional metrics of success, like profitability. The belief was that these new-age internet companies were a surefire bet, even if they had yet to turn a profit or even generate substantial revenue. However, as with all bubbles, the dot-com bubble eventually burst. The markets came crashing down around the turn of the millennium, wiping out billions of dollars in investment and plunging numerous tech companies into bankruptcy. The Nasdaq index, heavily laden with tech stocks, plummeted from over 5,000 points in March 2000 to just over 2,000 points by the end of the year. The aftermath of the crash was a severe blow to the tech industry. It took years for the sector to recover, and many of the high-flying dot-com companies disappeared entirely. But it also served as a wake-up call. Investors became more cautious, and companies realized that they needed more than just a catchy domain name and a slick website to succeed. In the end, the dot-com bubble serves as a stark reminder of the dangers of overvaluing companies with no profits. It shows us that while innovation and technological advancement can create fantastic opportunities, they also bring with them risks. And as we'll see in the next scene, These risks can sometimes lead to catastrophic financial crashes. The dot-com bubble served as a stark reminder of the dangers of overvaluing companies with no profits. The year 2008 witnessed one of the most devastating financial crises in history. It was a year that shook the very foundations of global economies and left no stone unturned. A time when Wall Street met Main Street in a clash of monumental proportions. Central to the crisis were two key factors: subprime mortgages and financial deregulation. Let's start with subprime mortgages. In the mid-2000s, banks started giving out loans to individuals with less than stellar credit, often without verifying income or assets. These risky loans were then bundled together into complex financial products known as mortgage-backed securities. As more people defaulted on their loans, these securities plummeted in value, triggering a domino effect that rippled through the global financial system. At the same time, financial deregulation had allowed banks to become more entwined than ever before. The repeal of the Glass-Steagall Act in the late 90s, for instance, meant that commercial banks could engage in investment banking activities and vice versa. This blurring of boundaries created a tightly knit web of financial institutions, all vulnerable to the same risks. When the subprime mortgage market collapsed, it sent shockwaves through this interconnected system, leading to a full-blown financial crisis. The impact was global and far-reaching. From Wall Street to the streets of Reykjavik, no economy was safe from the fallout. Millions lost their jobs, homes, and life savings as banks crumbled and stock markets plummeted. In response, governments around the world stepped in with unprecedented bailouts and stimulus packages to prevent total economic collapse. But the crisis also sparked a wave of reforms. Regulations were tightened, transparency was demanded, and an emphasis was placed on responsible lending practices. It was a stark reminder of the dangers of unchecked financial innovation and the importance of robust regulatory frameworks. The 2008 crisis reminded us of the perils of complex financial products and lack of transparency. It served as a harsh lesson in the dangers of unchecked greed and the profound interconnectedness of our global financial system. Despite the devastating crashes, financial markets have shown remarkable resilience. This resilience is a testament to the adaptability of economies worldwide, an adaptability that's rooted in the many lessons learned from these turbulent events. One of the most critical lessons is the undeniable need for regulation. From the reckless speculation of the Roaring '20s that led to the Great Depression, to the lax lending standards contributing to the 2008 financial crisis, it's clear that oversight and regulation are essential to maintaining market stability. They act as the guardrails on the financial highway, keeping us on course and preventing us from veering off into chaos. Transparency, too, has emerged as a vital aspect of financial stability. The dot-com bubble taught us that hype and speculation are no match for solid, transparent business practices. Investors and stakeholders need clear, accurate information to make informed decisions. Without this transparency, we risk building castles on clouds, buoyed by nothing more than hot air and wishful thinking. Sound financial practices as well are a cornerstone of stable markets. The 2008 financial crisis underscored the dangers of unsustainable debt and risky financial products. It reminded us that the quest for quick profits should never overshadow the need for responsible financial behavior. But it's not just about avoiding the pitfalls. It's also about harnessing the power of innovation to bounce back from these crises. Each crash, each burst bubble, each financial upheaval has spurred a wave of innovation in its wake. From the establishment of the Securities and Exchange Commission in the 30s to the rise of fintech solutions after the 2008 crisis, innovation has consistently played a crucial role in rebuilding and strengthening our financial markets. These historical events serve as a stark reminder of the cyclical nature of financial markets. They remind us that while crashes and downturns are part of the journey, so too are recovery and growth. And with each cycle, we learn, we adapt, and we come back stronger. In the face of adversity, the financial markets have always bounced back, stronger and more resilient. This resilience is not a mere stroke of luck. Rather, it's a testament to our ability to learn, adapt, and innovate. Each financial crisis, with its unique set of challenges, has spurred remarkable innovation. After the Great Depression, we saw the establishment of the Securities and Exchange Commission, a move that revolutionized financial regulation. The dot-com bubble gave rise to a new generation of tech companies who learned from the mistakes of their predecessors and built more sustainable business models. The 2008 crisis led to the emergence of financial technologies like blockchain and cryptocurrency, challenging traditional banking systems. These innovations, born out of necessity, have not only helped the market recover, but also paved the way for future growth. They have made our financial systems more robust, transparent, and inclusive. In the end, the history of financial markets is a testament to human ingenuity and resilience.